Sooner or later, someone tells you the magic words: become an S-Corp and stop overpaying tax. Sometimes that advice is worth thousands a year. Sometimes it quietly costs you more than it saves, and hands you an obligation you cannot quit. The saving comes from one thing only: cutting the 15.3% self-employment tax on part of your profit. Everything else about an S-Corp is paperwork and cost. If your profit is small, the cost wins. First, what you pay now. As a sole proprietor or a single-member LLC, your whole profit runs through self-employment tax. That is 12.4% for Social Security up to an annual ceiling, plus 2.9% for Medicare with no ceiling at all. That percentage is not a detail. On $60,000 of net self-employment earnings, it is over $9,000 before a single cent of income tax. It is the largest single line most freelancers pay and the one they understand least. Now, the crucial thing almost nobody explains: an S-Corp is not a different kind of company. It is an election, a form you file. Your LLC stays your LLC. You are only changing how the tax rules look at your profit. Once you elect it, you have to split yourself in two. Part of you becomes an employee who draws a salary. The rest of the profit reaches you as a distribution. The payroll taxes hit the salary, and only the salary. That is the whole trick. The distribution side escapes Social Security and Medicare tax entirely. So, the lower your salary, the lower your payroll tax. Which raises the obvious question: why not pay yourself almost nothing? Now hear what that word salary actually commits you to. Not a transfer to yourself whenever cash allows. Real payroll, tax withheld at each run, filings on a schedule, deadlines that do not move because your client paid late, right? Which means an S-Corp turns you into your own employer. That is the part the enthusiastic advice leaves out. You are not simplifying anything. You are adding a machine that has to be fed every month, whether or not the month was good. Somewhere there is a crossover point. Below a certain profit, those running costs eat the saving whole, and you have simply bought yourself admin. Above it, the split starts genuinely paying. Where that line sits depends on your numbers and your state, which is precisely why this is a question for a professional, not a video. There is a second trap in the same family: irregular income. Payroll wants a steady wage. A freelance year is anything but steady. Committing to a monthly salary in January on a year you cannot forecast means either paying yourself money you have not earned yet or cutting your own wage and weakening the very claim you need to defend. The smallest salary you could defend as reasonable compensation is not automatically the best one. You are trading a certain saving today against an uncertain benefit decades out, and that trade depends on how much you expect to rely on that benefit at all. If you take one thing from all this, take the shape of the decision to say, below a certain profit, an S-Corp costs more than it returns. Above it, the saving is real, but it arrives attached to payroll, to paperwork, and to a mark on your own earnings record that lasts decades.